Thank you so much for coming. It's so great to have you. Welcome to our July Real Estate Opportunity Housing webinar. We're really excited to share kind of what's going on. And today we're going to do some really exciting myth busting. So let's get into it. Shivani's on vacation, so we're, holding the fort down. Okay. So first things first, our favorite disclaimer is to not try to catch a falling knife. You can't time the market. Things change all the time, but over time, real estate always goes up. So, you can plan your strategy to what's going on in the current market, but it's going to be pretty much impossible to buy low and sell high. So it's always a good idea to get yourself ready, because if you're ready, you can just stay ready and not have to rush last minute. Okay. Our agenda for the webinar, first, we're going to do an economic news market update. Then we're going to get into the myth busting and go over some common housing myths and how those impact your financing strategies. And then Nayeli is going to share an amazing success story. So if you've been following us for a while, you know that mortgage rates generally track with inflation. So let's talk about why. Investors investing in MBS or mortgage-backed securities are wanting to out-earn inflation, or at least make a return such that it's helping offset the erosion of the buying power due to inflation. So this is why inflation is commonly known as the arch enemy to mortgage rates. So what is inflation doing? Well, the Fed's favorite measure of inflation is personal consumption expenditures. And this report showed a drop to 3.8% from 4.3% from last year, which is huge considering last year we saw a peak at 7% inflation. This reading excludes food and energy, which tend to be a little more volatile. So we're definitely trending the right way with inflation. The Fed began their rate hiking campaign with the goal in mind of lowering this inflation to a 2% target. This is why a recession is generally a good thing for mortgage rates. You'll have lower spending during a recession as everyone tightens up their budget, and lower spending leads to lower inflation. And we're seeing American spending start to slow. The jobs number is another big one we are watching, because this could be an indicator of future inflation or deflation. If you have strong jobs, then you have strong spending most likely, and then you have continued inflation leading to sustained higher mortgage rates. The unemployment rate coming out later this week, there's two different reports. We're getting the ADP report on Thursday and the BLS jobs report, that's the Bureau of Labor Statistics jobs report, on Friday. We're anticipating a small drop in unemployment and the creation of approximately 225,000 jobs. And then we also saw initial jobless claims fall to 239,000, representing the biggest drop since October of 2021. So jobs are pretty strong. But we're also tracking average hourly earnings, which can signal employees are experiencing a reduction in hours worked, or possibly even employers are doing pay cuts so that they don't have to lay people off. So they're kind of enacting these cost-saving measures by paying their employees less or working them less to avoid laying them off. So again, this is a bit hard to anticipate, but we're watching this closely, as this could signal a shift in the jobs market and possibly leading to a shift in, lower mortgage rates. And the last point I want to touch on for its impacts on mortgage rates are bank deposits. This rose after a steep fall a week before, and this is really good. If this continues, it'll ease pressure on banks having to sell off their bond holdings to meet liquidity needs, further helping stabilize rates. So essentially, if they need to meet their reserves requirements for the FDIC, they might have to sell their investments in mortgages to be able to have that liquid cash. And if they're able to stop doing that, then that will help mortgage rates. And finally, home prices themselves. So we have housing specifically, and home prices have appreciated for the fourth month in a row. And we just really still just don't have enough homes available. So we all know we saw a dip in home prices last year, and this year so far, we've been trending upwards steadily. So nationally, home prices rose 0.7% in April per the FHFA report, and 0.5% per the Case-Shiller index. So it's showing strong appreciation continued. So this continued lack of inventory is just a huge factor supporting continued home price appreciation. And as we see mortgage rates trend down over the next couple of years, we are highly anticipating an even bigger surge in buyer demand, which again supports home prices continuing to increase. So this leads us perfectly into our first myth.
So it is our job to ensure we are providing accurate information and being a resource for our clients, our community, and our business partners. We have been hearing a lot of incorrect information going around, which is why we are going over some myths that we're just hearing that we want to make sure we clarify for everyone so that you are not sharing information that's false. So first, wait until prices drop. You shouldn't wait to buy until prices drop because the longer you wait, the more expensive things get. Our real estate market has proved that waiting has increased the cost to buy a home due to prices not coming down and rates continuously increasing. The prices for homes have come up due to our lack of inventory, despite us having higher interest rates, because not only do we already not have enough housing, but also the people that bought a couple of years ago don't want to sell and lose their low interest rate and buy something more expensive and have a much higher interest rate, which is why if it makes sense for you to buy right now, you highly should consider doing so because as Sandy said, as rates come down, it's going to open the availability for more people to qualify, which means you're going to have a lot more competition, which means our realtors are going to be seeing multiple offers like they were seeing a couple of years ago and how we're seeing right now. Next one is you need 20% down. Don't let your uncle, don't let your grandpa mess up a deal for you because you're scared that you don't have 20% down to purchase property. There are a lot of people that think you need 20%, and that is absolutely not the case. Depending on the loan type that you decide, you can buy a property with as little as 3% down. And when you do put less than 20% down, you are going to have an added expense on your monthly mortgage payment of mortgage insurance, but it's not going to be anything ridiculous that's going to increase your monthly mortgage payment an unreasonable amount. All right, next we're going to continue with some more myths. And one that we're hearing a lot of people talking about is that you get to skip your first monthly mortgage payment. That is not true. We wish it was, but your interest is actually prorated. And when you look at your closing costs, you will see specifically how many days of interest you have prepaid. So you're not actually missing a payment. You most likely have paid for the remaining days of the month already in your closing costs, which is typically if you see you're closing in the middle of the month. For example, for people that are closing right now in July, they're like, oh, we're going to miss a payment. We're not going to pay August 1st, and their first payment is in September, but they're paying the interest from today to the close of July, and that is why their first payment isn't until September. So you're never missing a payment. You're always paying for it, but it's included in your prepaid closing costs. Another one that we're hearing, especially with all of the rates changing, is you need to wait for your interest rate to drop 1% before refinancing. And that's not always necessarily true. Everyone has a unique scenario. And within everyone's own financial needs, we all have different goals that we're trying to achieve. Some people want to have their mortgage payment drop with a lower interest rate. Other people want to consolidate their debt, and maybe they're okay with having the same or similar interest rate with them consolidating their debt. So that's why you need to contact us for us to run an analysis to see if the numbers make sense and align with your goals. So you don't always have to wait for rates to drop 1%. It all is depending on what your unique scenario is and what you share with us so that we can make sure we are achieving your financial goals. Next is your pre-approval rate is the rate you're going to get when you close. So right now we are seeing lots of shifting with interest rates. It's very volatile right now. So if we quote you a certain rate right now, that doesn't guarantee that that's going to be the same rate when we close. Some people find a house within 2 weeks of starting the process. We close within 21 to 30 days. Other people start the process in June, and then maybe they're not buying until October, which means that there can be a lot of movement within their rates. So don't always expect that same rate that you were quoted for it to be the quote that is given to you once you actually have a fully executed purchase agreement, because the rate can change. But that's where you're going to be communicating with your loan officer and with us. We always tell our clients, send us every single address that you like so that we can send you accurate and most current pricing, so you know what you're getting yourself into. We don't have any surprises. And some more is that you should wait to get pre-approved until you are ready. Depending on your finances, depending on your goals, it's always smart to get in contact with your loan officer or get talking about the process a lot further in advance than what your expected timeline is to buy, because we want to make sure that you're set and that you're prepared for when that opportunity comes along. Because what if right now, when we pull credit, you need to pay off some debt, or we need to work on increasing your credit score so that come in 5, 6, or 12 months, when you really do want to start buying, you're ready to go, and we're not dealing with last minute things that can impact what you're going to qualify for and what type of program that you're looking at. And then another thing is, a lot of people think, great, I got pre-approved, so I'm ready to go. I don't need to worry about it. No, that is not the case. When we do pre-approve you, we are doing our due diligence to make sure that we are reviewing your finances, to make sure everything looks good and in order, so that when you get into the actual process of having a fully executed purchase agreement with us doing your loan, that we do get to that closing table where you are signing your final loan documents. However, things can change if you decide to change your work, if your employment changes and the way that you get paid changes. If you go from working hourly to getting commission, that's definitely going to impact you. What if you're like, great, I have a great credit, I qualify for X amount, I'm going to go open a new credit card because I heard that for 4th of July, you get 20% off TVs. Do not open any new lines of credit. You don't want to accumulate new debt that could impact what you're qualifying for. And also, sometimes people unfortunately don't disclose everything that they don't know that they need to disclose. For example, like, let's say that you're on title for your parents' house. We need to take that into consideration when qualifying you. And if you didn't disclose that to us before, once we're actually in the loan process, we're going to find that out. So things can change based on your pre-approval, but if anything changes, always just make sure that you're talking to the loan officer and communicating changes so that we can adapt to them and make sure that you're still in a good place, so that we can make sure that you close and get those keys. And then, how good is your pre-approval for? So just like how I was talking about, a lot of things can change, and especially with rates right now, if rates go up, that might hurt how much you qualify for, because the purchase price might lower 10, 15, 20 grand with the increase in the rate. So your pre-approval, your rate's going to be constantly changing. So make sure you communicate with your loan officer. And also, your credit score is good for 120 days. So if you don't find something within the 3 months, we are going to have to re-pull credit just to make sure everything is still the same, because a lot can happen within 3 months. So with today's day and age, you want to make sure you're constantly communicating with your loan officer to make sure that you're not doing anything that's going to hurt your chances of still qualifying for that amount that we pre-approved you initially. And then this one is one that we've been hearing a ton from realtors, that when you get pre-approved, that the lender just needs to do a soft pull on your credit. And that's just not accurate. When we pre-approve you, we're going to look at your credit report. We have to pull your credit because we need to make sure we're doing our due diligence to make sure that everything is in line with your credit. So when we pull your credit, it is going to be a hard pull every time that we do so, but we will always ask for permission. We will always go over your credit as well with you. Okay, so more on credit. A lot of people that we sit down and we have client consults with, they'll say, oh, Credit Karma said my credit score is at 800. Why are you saying my credit score is a 760? Well, let me tell you why. Because Credit Karma is not 100% accurate. They only provide you 2 credit scores. When we look at your credit, we're looking at all 3 credit scores. So the information that is on there isn't all of the information that we see. When we pull your credit, we see it all. When they do your little soft pull, they're not getting access to everything, which is why most likely your credit score is going to be different when we pull it versus what you see online. And also, if you do have a Credit Karma app and it says that your credit is increasing or that your credit is dropping, most likely that is happening. So it's good to have some sort of credit monitoring service, but never expect that credit score to be exactly the same. And that is why it's super critical for us to pull credit for when we are talking about interest rates, because if you tell us you have a 798 credit score and when we pull your credit, it's actually a 750, that interest rate could change due to the difference in your actual credit score. And then another one is that you need to have excellent credit to be able to buy a house. Yes, the higher the credit score, the better it is for you to get into a house, but that's not always necessarily the truth. We work with a lot of different borrowers that have varying credit scores from 580 to 812. You name it, we've seen it all. We've worked with everyone. Depending on the type of loan program that you're wanting to get, can dictate what's the minimum credit score that you need to get. But if you talk with your loan officer, if you do have concerns about your credit, we can always advise you what we see, what our simulation says that you should do to improve your credit, or we can talk about you getting paired up with a credit repair specialist so that they can go in and repair your credit. So if you don't ask, you don't get. So always talk to us. We're the professionals. We can advise you on what's best with your credit if you do have any concerns. And then another one is sometimes we find clients that are coming to us and they're like, well, I paid off 2 credit cards and I used $6,000. So now I'm $6,000 short for my down payment or closing costs. Don't pay off anything until you talked to us. You do have concerns about credit. Sometimes we will have people pay off balances or pay down balances to help their debt to income ratio. Sometimes clients are concerned about some judgments or some collections. We will take a look at it and we'll tell you, you know what, based on our simulation, this is what you should do. And again, if not, we'll connect you with a credit repair specialist so that we can tell you what it is that you need to do to help your chances in qualifying. But you don't always have to pay off balances. Some people are like, oh, I can pay off my $500 balance, but paying off your $500 balance on that Discover card does nothing for us. So we'll let you know if it's necessary or if it's not. And then lastly, a lot of people are talking about student loans right now. Do I qualify with having student loans? How does that impact what I qualify for? Depending on the loan program, if you don't have a payment right now, we'll hit you for 1% or 0.5% of your total outstanding balance. Or what you can do as well is you can go to your creditor that lent you that student loan and ask for an income-based payment as well. So if you are concerned about student loans, call us so that we can tell you how that's going to impact your debt to income ratio.
Okay, let's talk about DPA. Everyone loves DPA. And I've been seeing a lot of information on social media about it. And social media is great. It's great for educating people. But there's just so much content flying around right now about DPA that we wanted to go over it and actually go over some facts and dispel some myths on it. So the reason that this is pretty complicated to talk about is because there are 2 main down payment assistance programs in Nevada. That's simple enough. You have your home as possible and your home at last. Home at last requires the property be in a rural address. So there's a little link you can check and see if the address qualifies. These ones are typically not forgivable, meaning if you sell or refinance the property anytime during the 30 years, you would have to pay back your down payment assistance that you got at closing. Home as possible doesn't have an area restriction, and these are typically forgivable. So if you keep that same loan that you purchased the home with for anywhere from 3 to 7 years, depending on which option you choose, then part of your down payment assistance gets forgiven every month that you make a regular monthly payment. So if you sell or refinance before your down payment assistance is forgiven, you may only have to pay back a portion of the down payment assistance you received at closing. Okay, that's simple enough, but it gets a little more complicated when you think about how these actually get given to a client. So you'll take, if you're applying for a down payment assistance loan, you would take your traditional loan, your conventional, your VA, your FHA, your USDA, and then on top of that, you layer a down payment assistance program. So when you look at it that way, there are over 55 combinations for down payment assistance in Nevada. This is further restricted by income caps, DTI caps, property location, eligibility, like I mentioned, first-time homebuyer status, etc. So it just gets very individualized. And this is why we really like to go over it with each applicant. Okay, what are your goals? What can we do? How would a combo make sense for you to achieve home ownership? Down payment assistance is great for reducing cash to close. That is its main purpose. So if you're trying to get your foot in the door, this may be the way to go. But another myth that I keep hearing, specifically from other lenders, is that down payment assistance is free, which is just not the case. So there are actually quite a bit of upfront fees. Most of these are rolled into the loan, which is good for helping reduce your cash to close up front, like the goal is. And then there's also higher interest rates typically. I did see for a little while where the down payment assistance was actually a lower interest rate, but again, with rates changing so frequently, this is very much a case-by-case basis, and you need to have a mortgage advisor who's constantly staying up to date on these things and can advise you as things adjust. So with these higher interest rates that come with most of these programs, that can really eat into your buying power when you're getting pre-approved and shopping for a home. So generally, if you have a down payment available, it usually will make sense to skip the down payment assistance option. Let me show you what I'm talking about. So this report is showing you a few different options for qualifying. So on the left here, we have a regular FHA loan. In this scenario, your maximum pre-approval is $400,000. Let's say you want to do the Homest Possible down payment assistance program. So this gives you 4% of the loan amount to use towards closing. And you can see it really lowers your cash to close, drops it from roughly $23,000 to $9,500. So that's pretty substantial. It also lowers your buying power from $400,000 purchase price to $350,000 purchase price. So you can see that for the same monthly payment, you're getting $50,000 less of home. So again, this is where we come back to, if you can get someone to give you a gift or something like that, it generally makes sense to skip that. This one is the home at last option. I just updated these today, so this is pretty real time. So this is your home at last rural option. Again, like I said, there are about 55 options for how to pair these together. So these are just a few scenarios. But again, cash to close quite a bit lower. Your max purchase price here would be about $345,000. Let's compare this to what would happen if we increase the purchase price to $409,000 and ask the seller to give us a $9,000 seller credit. So now the seller is making the same amount as this option. They're still getting $400,000. They're giving you $9,000. Your cash to close is lower, right? We're using that $9,000 seller credit to offset your closing costs. So we're kind of in the middle on cash to close compared to regular, or if you went with the down payment assistance program. But you're again shopping at $400,000, $409,000, and your payment is approximately the same. So again, this is just to show you that there's a lot of creativity with down payment assistance options, seller credits. How you structure your offer is going to make a huge difference on how the deal is for you, how you come out, what your monthly payment is, how much house you can afford, and long-term, what your goals are. So, okay, last myth, not all lenders are created equal, and it's really important to choose the right lender. Rate is obviously important, but as you can see, there's so much more that goes into a strategy. Should you pay points? Does a 2-1 buy down make sense? How long do you plan to live in the home? What are your long-term goals? Does your lender share market data with you and keep you informed about strategies that make sense and are evolving in real time? Do they run numbers for you on each and every address that you look at so you know with confidence that you're ready to make a decision, a huge financial decision? Do they pick up the phone on Saturday? Do they have a good reputation in your local market and call the listing agent when you submit your offer to really drive home the point that your offer is rock solid? Choosing your real estate team is a very personal decision. You need to choose someone who has your back, is on your team, and can help you structure your deal and make your mortgage strategy the best one for you now, in 1 year, in 5 years, and as your financial plan changes and you reach your goals. Choose someone that makes the most sense for you and will be with you all the way, which transitions us right into our success story that Niley is going to share.
Thank you, Sandy. So my success story is I just did a closing on Friday for clients that I've been working with since 2019. So since 2019, we've been trying to get them to this point where they're signing their closing docs, they're giving their down payment, they got a seller credit for closing costs, and now they are first-time home buyers, and they're super stoked because finally they have a house that they can build into a home and create memories with their children. So with this couple, if it was an employment, it was credit, it was debt, you name it, I started with them and I was very transparent about how we were going to have some challenges. But if they worked with me and were able to achieve the different stepping stones that I put in place for them, they were going to be able to achieve home ownership. So 4 years later, they finally qualified. But also, when you think about it, like how ironic is it that the market since 2019 is extremely different from what today's market is. So that just really goes to show that even though it's a lot more expensive right now, it doesn't matter what the market is if you don't have your finances in check, which again is super critical to make sure that you pick the right team that's going to have your back. And just because it doesn't make sense to purchase right now is just going to forget about you because you're not someone that they can put in their pipeline. We are here for you from the very start to finish, whether it takes 21 days, 30 days, or 4 years. So we want to make sure you have the right team creating a very strong strategy for you so that you can attain home ownership. So that is our success story for today.
Awesome. Thank you, Niley. And then if anyone wants to book a call with us, you feel free to scan this QR code. And like I said,